Welcome to the Red Cloud Research Roundup, hosted by Red Cloud Financial Services. It's June 20th. Last Thursday, Dave Talbot, Managing Director of Equity Research, and mining analysts Taylor Combaluzier, Koby Kushner, and Timothy Lee from the Red Cloud Securities Research team sat down for a special edition of the Roundup to recap PDAC 2022 and chat about some notable mining news that happened along the way.
Hello, and thank you for the warm welcome. Welcome to episode 10 of Red Cloud Securities Research Roundup podcast. I'm Taylor Combaluzier, a mining analyst at Red Cloud. Dave, Tim, Koby, and I are all together in the same room for once, and we are pleased to join you today as part of an ongoing series of discussions with the Red Cloud Research team. This week, we wanted to start off with a recap of the PDAC convention in Toronto. It was the first in-person convention since 2020, and it was great to see everyone again. Despite the turmoil in the markets, everyone I came across was happy to be back and felt that it was important to have face-to-face interactions. While this year's show was more compact with both the Investors Exchange and Trade Show in the South Building, it still provided a lot of content. It was also interesting to have the convention in June as opposed to its typical occurrence in early March. Anecdotally, most everyone I talked to preferred coming out in June. It really allows you to avoid the slush, wind, and snow. You also don't need to deal with coats and can enjoy time out on the patio. Though the timing this year presented challenges for students who often make the pilgrimage to PDAC in March in search of summer jobs, as well as those that are out conducting summer field programs, this year was just too late for them. While full statistics are not yet available for this year's convention, the top line number was released by the PDAC. In 2022, total attendees numbered 17,445. That number is down 25% from the 23,000 attendees at the 2020 convention, which was right before the initial COVID-19 lockdowns. And it's down 32% from the 2019 convention that saw almost 26,000 attendees. Dave, you hosted the uranium session at the convention. Why don't you tell us a bit about that?
Yeah, thanks, Taylor. I did chair the PDAC uranium session and the Investors Exchange. I did see the numbers down in the room. I would say usually we've got about 140, 160 people in the room. This year it looks like we started just shy of 100. But considering the fact that talks were about 12 minutes long, 10 to 12 minutes long, we got through about 7 companies in an hour and a half. And what I found is that when people came to the room, they actually stayed for the duration. So the numbers didn't really change all that much. Now, the number of companies speaking at the Investors Exchange, that was down quite a bit this year. I think usually there's 140 companies. This year there was 28. So it was quite a big drop. Now, I think there will be additional companies speaking towards the end of June. We've got the virtual PDAC event, and anybody that got the all access pass for this event can tune in for that, and it's going to be a whole new content. So I guess maybe specifically on the uranium side, the talks were generally upbeat in that conference. Despite the fact that the market was off for a lot of the week. This sort of follows, news in the U.S. The government plans to buy domestic enrichment and uranium. So the uranium stocks have pulled back since that a little bit, but I'd say most stocks are still above their recent May low points.
Great. Yeah, and then what I saw, in spite of challenging markets for the equities, the long-term thesis really remains for commodities, particularly in the battery metal space. So while there is some shakiness in the market now, there does remain a long-term kernel of optimism among investors and companies in the metals and mining space. And talking to a few companies about they were busy back-to-back with meetings, although many of them were with other corporates, and we may see some deal making come out of the conference this year.
Yeah, there was definitely some mixed sentiment here, and I guess for our listeners, we're all in the same room for once. This time we're all talking to each other, so a little more casual this time around. But yeah, I think everyone's sitting at their booth with a smile on their face. Maybe they were secretly crying inside looking at their portfolios here. The S&P was down 9% week on week on the Monday, and it went further down into Tuesday. Commodities in general suffered too. We saw gold pull back to the 1810 levels. Wednesday saw things cool off after the Fed announcement. I think they announced a 75 basis point hike. And generally, they were expecting 50 basis points. But yeah, the bloodbath appears to be continuing this morning now. So as of this podcast, which is Thursday midday, the S&P 500 is at its lowest level since about mid-2020. Commodities, at least, are back up this morning, generally. We saw gold come back up now in the 1840 to 1850 levels. Unsurprisingly, the GDXJ, so that's the Junior Gold Miners ETF, that one's also up. But it's still at pre-pandemic levels. We know here, miners are typically leveraged to gold miners. But taking a 5-year view here, gold is up 47% over 5 years. The GDX and the GDXJ, they're up 39% and 13% respectively. So I wonder, is there a real disconnect between gold and gold equities, or is this more so related to the profitability of miners given the cost inflation seen across the board? I don't know. What do you guys think? Maybe it's a bit of both. Maybe I'm missing something.
I do think we are at an early stage in a bull market. A couple of the commodities that I'm looking at, uranium and lithium, battery metals in general, a lot of supply is going to be needed in the next few years. You look at uranium prices sub $50 a pound. That's not really at an incentive price yet. There are a few projects coming online that can handle that, but I think for the most part, we're going to need $70 a pound to get some of these mines up and running, or some of the mines return to operation. You look at the lithium sector, and then that's not just lithium, but nickel and graphite and cobalt. We are looking at usually between 11 and 17% compounded annual growth rates for all of those commodities that are involved with lithium-ion battery production. So we're going to need a lot of commodities here, and I don't think we necessarily have, maybe outside of lithium, of course, have the prices need to sustain some of that long-term growth.
Yeah, and you mentioned incentive prices of 70. I remember a few years back, people were talking about incentive prices being 50. So what's changed? Is it the cost to get it out?
I would say a bunch. There's a few things. First of all, inflation is pretty rampant right now. I just got back from Utah, took a look at a uranium mill and a bunch of projects, and they need to be some of them need to be refurbished. The mill is in great shape, but it does cost a little bit more to run that. You need to make sure you maintain your people. At least that's already built, so it's not a huge concern. But other mills out there that are not yet built, or other mines that are not yet built, even recent feasibility studies are now a little bit out of context. So, you could almost add 20-25% to any recent feasibility study over the last couple of years. And that might become more of a reality.
Yeah, maybe it also has to do with, just the volatility of everything, including uranium prices. But I imagine producers want to see at least some stability, or they want prices to be high enough to the point where they can stomach a little bit of volatility.
Yeah, it does stem from demand. Ultimately, you need utilities getting back into the contracting mode, and later on I'll talk about a company that just happened to contract some material today, so or at least yesterday they announced. So
yeah, so I guess touching back on gold now. Someone at the conference asked me why gold isn't higher given all the inflation happening. And I reminded them that if it weren't for all this inflation, gold would probably be a lot lower. Gold has historically been a better hedge against the US dollar than it has been against inflation. And the US dollar, as measured by the DXY index, is up 8% a year to date. So gold's up more if you measure it in almost any currency aside from the US dollar. Add in market uncertainty, the VIX continues to trend up, and I'm seeing more and more companies announcing layoffs. I don't know if you guys caught that yesterday. Wealthsimple announced that they're laying off 13% of their workforce. So I suspect we're going to see a lot more announcements like this, especially given especially from other high-tech growth stocks. The fact that we're not seeing the typical negative correlations between the dollar and gold tells me that investors still see gold as the safe haven asset. Some people thought crypto would beat gold as the de facto safe haven, but year to date, Bitcoin is down 54% and Ethereum is down almost 70%. So gold has been doing its job, hasn't lost its luster, and personally, the fact that it's been relatively stable has reaffirmed my belief in it.
I think one thing that has obviously majorly impacted the industry over the last few years are world events, including COVID and the Ukraine invasion. COVID has been a two-edged sword for gold as the gold price increased when it first kicked in, but the cost of mining has also gone up. I have at least one gold miner that says the cost of extra testing and extra staffing that they have to have has added about $200 an ounce to their cost base. And I was just speaking with a gold miner in Spain that said their costs skyrocketed this past quarter because of high energy prices in Europe. And that's really impacted them very dramatically.
Yeah, I can imagine. I don't think the uranium sector was largely impacted like some other sectors. The mines typically are a little bit smaller, so they aren't necessarily as energy dependent. Small underground footprints, not as much energy input. However, I'd say the Ukraine invasion had huge impact on the sector. Obviously, the U.S. uses about 20% of its electricity comes from nuclear power, and out of that, about 20% of the uranium comes from Russia, and 40% of the enrichment comes from Russia, and most of that product is out of Kazakhstan as well. So, the risk here, and the risk still is out there, is that Russia decides to shut the U.S. off, cut it out, and essentially no longer send its uranium overseas. Now, we are also seeing some issues as far as getting uranium out of Kazakhstan and into the U.S. It has been done. Cameco's tried it, and they say it can be done. But it is an issue, and it remains to be seen whether or not that is propping up the uranium price here towards $48-50. So, does it matter at the end of the day? No, we still need higher prices to ensure we get security of supply going forward. And I think the U.S. has woken up to the fact that the Section 232 from several years ago that said, our industry is at risk from foreign powers. I think that just proved they were right.
Yeah, and I guess we touched on lithium a little bit before, and I can't not talk about it. Especially, it was interesting to see the prospectors tent this year. There was a lot more lithium projects being showcased than I'd ever seen before at PDAC. Granted, Dave, you've been to a lot more PDACs than I have. Same with you, Tim and Taylor. What do you guys think?
I do think there's more of a trend towards the hard rocks. And part of that is because I'd say the Canadian lithium industry, exploration industry, has sort of woken up a little bit. I think there have always been a lot of Quebec explorers in the past. I think Nemaska led the way for several years, Canada Lithium as well. However, this time around, we're getting a lot more explorers from different parts of the country. We're starting to see them in, obviously Quebec, now Ontario, Manitoba. We're seeing even in New Brunswick. So there's more of a diversity in the Canadian companies. With that, we have seen a lot of M&A activity over the past several years where Argentinian assets have been picked up largely by the Chinese, and that's something that will probably continue. I don't think we're going to see the same outcome with the Canadian assets, so I don't see them going to Chinese buyers ultimately. I think they will be reserved for essentially local production of battery materials.
Sure.
Which is different.
And I have some notes here. going back to that Goldman report. So we spoke about this on episode 8 of the podcast and shared our thoughts then, and I'll try to avoid any repetition. But I guess since that episode, other firms have come out and explaining where they disagree with Goldman and where they agree. So Benchmark Mineral Intelligence, which is a company, how would you describe them, Dave?
They're essentially a price reporter. They will do the marketing sections for companies' for companies' feasibility studies. But these guys, they came out of the price reporting on the graphite side, and they've been doing this on the lithium side now for probably 6-8 years at least. They speak to Congress, and they've got essentially great detail on the number of battery plants being built around the world, what inputs are required, the outlook from the supply side. So, I've worked with them for several years, and we have recently at Red Cloud as well.
Right.
So I'd say ultimately, yes, they're a price reporter, but they're call them a supply demand information company.
Yeah,
they certainly help us out.
Yeah, so they put out an article following up on that Goldman report, and they gave 5 reasons as to why lithium oversupply is unlikely. I'm not going to read the article word for word, so I'll just try and summarize it here. The first reason was that the industry can't rely on China's feedstock. So this does touch on the quality of Chinese lithium sources, which are typically lower and might be especially hard to produce meaningful volumes of, let alone of battery-grade quality. Reason 2 is that capacity does not equal supply. Benchmark distinguished the difference between the design capacity and effective capacity and provided examples on how building upstream of the EV supply chain rarely goes according to plan. Reason 3 is that new lithium supply comes at a higher cost base. This one sounds self-explanatory, but there's more to it. So lots of the low-hanging fruit has been picked. New lithium comes from lower grade deposits, and some new supply relies on new technology, which could further add to the cost. They didn't mention DLE, but I imagine that might be one of the things that they're thinking of here. Benchmark also brought up that new feedstock sources aren't necessarily compatible with old converters, so there's added costs there. Benchmark's view is that as a result of the increasing cost, it's unlikely that lithium prices will drop back down to previous lows. Reason 4 is about the importance of contract pricing. And this is something you brought up with the uranium spot versus contract. So it touches on how contract prices tend to lag spot prices. So according to Benchmark, lithium prices, and I quote, are very unlikely to crash. And the author does emphasize that there's not one single lithium price.
And I would say that's an even more important in lithium and a lot of the industrial minerals. They're not creating one product. Not every product is equal. And even, several years later, the deposit might not be delivering the same kind of purities. So it's not like gold or copper or even uranium where the material coming out is essentially a uniform product. There's a rather extensive qualification period required for things like graphite and lithium. Not every converter can use the same material. It comes right down to it.
Sure. And the last reason is something that, it didn't cross my mind, but it touches on lithium chemical capacity. So a lot of the chemical capacity is being used to reprocess material that does not meet those downstream specs. So new capacity is expected to be less efficient as a result. Furthermore, a significant proportion of capacity that finds its way to the market is locked into reprocessing or tolling agreements that won't address the market shortfall. The conclusion here is that the lithium market remains in a structural shortage. A correction in Chinese prices is likely, but the spot market in China does not represent the true price of lithium in the market. And, we're touching on Benchmark here, and I will say that they released their latest price assessment report yesterday. We didn't see any changes to hydroxide prices in the last week, given the limited Chinese demand for NMC batteries right now. But carbonate prices, on the other hand, both technical and battery grade, they ticked up 1.5% and 0.4% respectively week on week. Carbonate is used in LFP batteries as opposed to hydroxide. And this is somewhat counterintuitive, but the technical grade carbonate is actually what's used for these LFP batteries as opposed to the battery grade. So LFP demand has been on the rise. Nickel and cobalt free. This is a nickel and cobalt free solution. And in China, it now makes up over 60% of new cell production, which is a huge jump. I remember seeing in, a month or two ago, it just reached 50. So it's growing fast. But lithium seems to be the one constant in all the dominant battery chemistries, right? So.
Okay, well, thank you for the discussion, guys.
Thank you all for the roundtable discussion. But we're not done yet. Next up, we're going to dive into the team summary of the major events in mining from last week. David, why don't you kick us off first?
I'm David Talbot, Managing Director, Head of Research here at Red Cloud Securities. The uranium market does remain active. Uranium price is rebounding quite a bit. It started June at $48.50 a pound before rising to over $52 a pound for a couple days on some spot buying before settling back to $48.75 late last week. As I said before, the uranium stocks have pulled back a little bit recently, but most stocks are still above their recent May lows. Now, there are a few uranium companies I'd like to mention this week. Let's start off with Valour Metals. We have a buy $5 target price on this one, and this is a banking name of Red Cloud's. Its long-awaited $11 million exploration program at Angelac and Nunavut continues to impress. RC Drilling has hit uranium in 17 of the first 21 drill holes, and last week the J4 West Zone drilling provided scintillometer results of over 12,000 counts per second over 4.6 meters. Now, about 40% of a 1,000-meter long conductor has now been tested, and this zone is located near the heart of the Lac 50 resource area, between the eastern extension and the J4 and Ray deposits. And the J4 Ray hosts about 15 million pounds of uranium at 0.3 U3O8, or roughly about a third of Angelac's 43 million pound resource. So we expect this could lead to resource additions down the road. And prior to this, RC Drilling also returned strong radioactivity at Dipole and Yat. These are targets on the other side of the basin with potential for polymetallic mineralization at Yat. Another company I'd like to talk about is Global Atomic. We have a buy and $7.20 target price on this one, and this is also a Red Cloud banking client. Now, Global Atomic just recently received an LOI from a major North American utility to procure uranium, and contract negotiations continue. The offer represents 2.1 million pounds over 6 years, and pricing appears to be spot market related with floors and ceilings. Now, this is a relatively small but important deal. It represents just 7% of DASA production over the period, but it's a strong stamp of approval, and it may also help support debt financing. We expect an updated resource and mine plan towards the end of the year, and that should provide significant improvements to Phase 1 economics. And the final two companies I'd like to talk about are Consolidated Uranium and Energy Fuels. Now, we recommend both stocks as a buy. Target prices are $4.15 for Consolidated Uranium, $16.25 per share for Energy Fuels, and Consolidated is a banking client of ours as well. The two companies recently had a site visit to operations in Utah, and I gotta tell you, it's great to get back to that area. The companies are working together to bring 3 consolidated uranium mines towards production: Daneros, Tony M, and RIM. And these are past producers with over $100 million sunk in capex. We don't believe they require much capital to restart, and they can likely get back into production in short order. Consolidated is currently drilling at Tony M, and the goal here is to confirm and expand resources at the other mines as well. Energy Fuels' nearby White Mesa Mill makes this all possible. Consolidated has an exclusive toll milling arrangement with Energy Fuels, and its people will be intimately involved in the refurbishment of these mines. This is a unique site, the only active conventional mill in the U.S. It can handle radioactive alternative feed, vanadium, and now mixed rare earth carbonates. White Mesa just started up an alternative feed run that should see it produce about 150,000 pounds over the next several weeks with very little cost. Meanwhile, Energy Fuels looks to ramp up its new rare earth element circuit and continues to look for additional monazite feed for this, including the purchase of its own Brazilian asset. This mill provides all sorts of optionality for Energy Fuels, not even mentioning its other ISR processing facilities in Texas and Wyoming. And the consolidation and pending startup of these 3 mines by Consolidated is transformational for that company. It should help re-rate Consolidated Uranium from a consolidator to a uranium producer in short order. To close, I'd like to remind listeners that Red Cloud will be hosting its annual uranium conference this Thursday. 24 companies will be presenting. Keynotes are expected from Sprott Physical Uranium Trust and Horizons Uranium ETF. There will be a buy-side panel with L2 Capital, Tribeca, and Sachem Cove, and we do expect a great turnout. So that's this Thursday, June 23rd, starting at 9 a.m. So please see redcloudfs.com for more info and to sign up. Over to you, Taylor.
Thanks, Dave. This week I'll be speaking about Canada Gold Resources. We currently have a buy rating and $1.85 price target on the stock. Canada Gold is a Red Cloud banking client. Last week, Canada Gold reported assays from 7 holes at its 100% owned New Polaris project in BC. Results from the C10, C-West main, and a new, deeper vein were released, with 1 hole intercepting all 3 veins. Highlight intercepts in the new vein included 7.54 grams per ton gold over 18.6 meters, which works out to a grade thickness of about 140 gram meters, as well as 12.3 grams per ton gold over 2.3 meters in a different hole. The intercepts on the new vein are deeper than the current resource depth of 600 meters and are amongst the best results from the company's recent 30,000 meter drilling program. Assays have been received for 50 of 54 holes from that infill drill program. We continue to believe that Canada Gold has significant potential to expand the New Polaris resource at depth and upgrade existing resources to higher levels of classifications through this drilling. An additional 4,000 meters of drilling is planned for the summer of 2022, with all the results expected to feed into an updated resource estimate at the end of the year. The New Polaris project is one of the highest grade gold development projects in the world, with an average grade of 10.5 grams per ton gold. This is approximately 7.8 times higher than the global average and makes the project the highest grade primary gold project in Canada amongst development stage peers. Tim, over to you. What have you got for us this week?
Thanks, Taylor. This week, Pasofino Gold reported results of a feasibility study for its Dugby Gold project in Liberia. We have a buy rating and a $1.90 price target for Pasofino. Based on the study, the mine would have average annual production of just over 160,000 ounces for a 14-year mine life, including average production of 200,000 ounces for the first 5 years. Initial capital costs would be US $391 million plus owner's costs. The result is a robust project economically. Using a US $1,700 an ounce gold price, the study yields an after-tax NPV of $530 million, with an IRR of 23.6% and a payback period of 3.5 years. All-in costs would average just over $1,000 per ounce. Overall, this is an important milestone for the project and the company. Importantly, completion of this study means Pasofino has earned into a 49% ownership of the project, with Hummingbird Mining retaining the other 51%. This can be converted to 100% for Pasofino prior to the government's 10% carried interest by converting Hummingbird's 51% project ownership into a 51% shareholding in Pasofino. Overall, this study demonstrates positive economics and is an important milestone in moving the project forward.
Thanks for listening to the Red Cloud Research Roundup. We hope you enjoyed our roundtable discussion to recap the first in-person PDAC in a couple of years and the highlights from recent notable mining news in Red Cloud's coverage universe. Remember, you can join us every Monday for new episodes. And as always, head over to redcloudsecurities.com for full disclosures and to sign up for our email list. That's it for this episode, and see you next time.